Welcome, everyone, to w360's latest installment of our education series, where we are trying to ensure that our board member clients, those that aren't even clients of ours, and just community leaders in general, that you have the right information, the best practices, and the expertise, whether it's coming from us or subject matter experts like we have on today's call, tackling reserve studies, both kind of just the approach of their importance in community management. We will touch a little bit on the differing requirements that do exist in some states where they've already become a mandate, and other states like Illinois and others where they're more of a best practice as of right now until they become a mandate. But there's a lot of great information in today's session, particularly as folks who were on our budget webinar a couple of weeks back know about the impact that reserve studies have on lending guidelines that are changing as of January 1st via Fannie Mae and Freddie Mac. So there's a lot of wood to chop and a lot to discuss. So without further ado, I wanted to get into introductions. Just briefly, I'm Eric Stazak, Executive Vice President here at w360, responsible for business development and growth. Historically, I've also been the department head for all of our association operations, and I've been with the organization for 13 years in total. With us, we have our sage resident experts at Reserve Advisors, particularly Henry McKenna, who is on today's webinar and will be presenting to us. So Henry, could I shoot it over to you for an introduction to yourself and the firm and to get us going?
Absolutely. Thank you so much, Eric. It truly is a pleasure to join you all tonight and cover some of these hot topics within reserve studies, especially as we're getting into budget season here, and all this is very top of mind. So I truly do appreciate you guys joining me tonight. I really do like doing these education sessions a lot too, so it is a pleasure for me. And with that being said, I'm going to go ahead and share my screen, Eric, so we can get this rolling here.
That sounds great. And I'll just take a quick minute to just share with everyone, if you do have questions or any comments or anything like that, we do ask if you could just log, if you're worried about forgetting them, just log them in the chat. We've got myself and others monitoring. So we'll make sure that we'll get to your question, or feel free to hold it. We will have Q&A towards the end, but would be great to let Henry kind of get through everything on his end, and we'll make sure that we address any feedback. We can go back to a slide or anything like that. But if folks can allow Henry to get through his presentation and dive in, that would be appreciated.
Yes, much appreciated there. A lot of content we're going to go over today. I hope to get this done within 30-40 minutes. Yeah, sometimes I do get a little long-winded on some things, so if I go over, I apologize. But I do promise you I will get to all the questions that are in the chat here, and if we don't get to them, by all means, Eric, we can facilitate that. I'm happy to follow up with anybody in the future too to answer any of those. With that being said, I'd like to dive into this. Eric, is this being shared good? Are we all set to go?
We are. Folks, can you see the screen okay? I'm seeing it okay on my end. I think we're
Perfect.
all set.
Awesome. Well, Eric, thank you again for the introduction. Once again, I am Henry McKenna with Reserve Advisors. I am our senior account manager. I am personally located in Chicago, Illinois. But I do handle quite a bit of area, not just within Chicago, but throughout the country, as our company at Reserve Advisors is a nationwide country and actually international at this point too. We pretty much service everywhere. I've been doing this for quite a long time now. I've collaborated on over 3,000 reserve studies, and I've seen a little bit of everything out there too. Of course, this idea of the reserve study is mainly tailored to homeowner community associations, but we've worked with a lot out there too, because it's the whole idea of budgeting and having a third party unbiased perspective of helping you guide these budgeting decisions goes beyond just communities too. So we've had the pleasure, our team, working with hotels, resorts, religious facilities like churches and commercial properties, and of course golf courses too. Once again, these concepts of having that third party is really important too. So we've seen it all out there, and I'm really excited to kind of give you guys my perspective on some things here. And with that being said too, our agenda today is going to be covered in 3 major parts here. So number one, I do want to start off the presentation on some of the current legislation. Like Eric brought up, we are seeing a lot of changes on the state side nationwide here. Every state's a little bit different there, and I look forward to covering that too. And I think the hotter topic right now is these lending requirements, what we're seeing with Fannie Mae and Freddie Mac. So happy to cover those. I also want to go over, for the folks who may be unfamiliar with the reserve study, what this product actually is. How do we develop them? How do we, what's all included in the sauce here? How does this all put together in order to provide communities with reserve studies? And then lastly, and I think really important here, with budget season in play, how do we use these reserve studies? Getting them is one thing, but how do you as board members, managers, actually put this thing to work and really get the value behind them? So once again, excited to dive into all these. And as you have questions, put them in the chat. Look forward to getting to them at the end of the session. So to kick things off here, reserve studies, really a hot topic the past couple years. There has been such an intense, increased scrutiny on capital planning itself. And I'd be remiss not to mention that, of course, this was a big catalyst from the tragedy that did happen with the Champlain Tower South in Surfside, Florida back in 2021, where nearly 100 people lost their lives. Unfortunately, a very tragic event that really did put a major spotlight on this idea of capital planning and really getting ahead of the ball, not waiting to the last minute to take on these large structural projects and really just capital expenditure projects in general too. So there's a lot that we learned from Surfside out there, and it's not just Surfside that taught us these things. Unfortunately, we've seen this throughout the industry for a very long time. And it's the idea of, we all know at communities and we all know at these shared structures and whatnot, that there's going to be projects. Nothing lasts forever out there. And it's really important that we do put some sort of plan in place and understand what our true needs are out there. How do we go about these projects, and what can we expect?
What do we need to my earphone somehow?
What do we need to plan for in order to best set us up for the future? So when I got into this industry too, the idea of reserve studies, they really were just a best practice. Communities did them for many years out there, and it was really to hold their fiduciary responsibility and to have that third party partner. Past couple of years, this has changed a lot. This is no longer a best practice. We're seeing this really turn into a necessity out there. And so what we're seeing is two different forces out there. We're seeing state legislation come into play throughout different states, having immediate impacts on requirements of reserve studies and what communities need to do. And I think even more important too, we're seeing these major lending institutions and insurance companies get involved too, to evaluate the risk behind communities and where they want to see those reserve studies and understand what those potential risks may be. So first and foremost, I know we have a lot of folks on this call from different areas around the country. And so your specific state is going to vary. There is a lot of different rules and regulations out there, and everybody's a little bit unique. So what I have posted here on the screen, this is from Community Associations Institute. This is a really great resource, and I encourage everybody to go to their website to learn more about your specific state, because once again, everybody's very unique. There are some states that have very strict rules on getting reserve studies completed by a third party. Other states even have certain rules on following those funding recommendations. States like Florida that are very aggressive for enforcing communities to ensure that they are doing their structural integrity reserve studies and funding for those projects. And then, of course, too, there's a couple of states still left in the nation here that have no statutory guidance or no requirements for reserve studies. But that's not to say that we would expect some change for that in the future. So once again, this does vary state by state. What we are seeing, though, is a 5-year cycle is becoming the most common trend out there. Now, me personally, I'm located in Illinois. For the past few years, the folks in Illinois have been playing and tinkering with their bill. And if you ask most people, I think everybody's going to say that this bill is eventually going to go through. The debate right now is really just the specifics of who's going to be involved, what's going to be the full requirements of which communities, and what does that funding requirement look like too? Is it going to be forced to fund per what the reserve study says, or is it going to be up to communities again? It's a lot of that's being put into play right now, and we're seeing that for a lot of states. But one thing that I did see that we are seeing that's very consistent is we are expecting 5-year updates from a lot of states out there. And once again, the trend is really clear. Whether you're in a state right now that doesn't have requirements, we are seeing a very quick shift for a lot of states that are beginning these conversations right now and starting to develop and having productive conversation of what that expectation is going to be moving forward. So I wouldn't be surprised, once again, if there's not a bill in place in your current stage. I wouldn't be surprised if there's going to be something out there within the next couple of years that's going to have something regarding reserve studies or funding statutes. Once again, linked below here too is CAI National website. Really great resource to check out too if you're interested to see what your particular requirements are going to be in your state. So after Surfside and after we started seeing these state legislations pop up, one of the biggest questions that we were getting as a reserve study provider is who's really going to police this? You know, is there going to be state representatives that are actually going to be going door to door, clubhouse to clubhouse, knocking to see, do you have a current reserve study? And of course, no. Logically, that's not possible out there. And there's not going to be different checks per states out there. So the big question was, how are they going to know if we're actually getting these studies done, and who's going to actually check and verify this? And what we found out very quick was that the lenders are really going to be the major police and the major enforcers between who's actually getting reserve studies and who's not. Biggest enforcer here is, of course, Fannie Mae, who approximately has nearly 75% of the condominium mortgages throughout the country. They really are becoming the major police behind this. Now, this year they did have new guidelines released that definitely put some trickles and some waves in our industry. A lot of questions out there that have a major impact. But I think these are really important that we do need to cover out here. Once again, they have such a big pull on the U.S. mortgage system. And even if you're obtaining a mortgage that's not Fannie Mae right away, there's a high chance that Fannie Mae is eventually going to buy over that in the secondary market too. So ensuring that your association is eligible through Fannie Mae and does not end up on this do not lend list is extremely, extremely important. So after this slide, we're going to dive into some of these guidelines too. But one statistic that I did look up here was that studies were estimating associations that are now getting put on this, what we call the do not lend list, are experiencing 5 to 30% decreases in property values, which I thought was pretty outstanding out there too, and pretty eye-opening as well. So making sure that your community are following these guidelines to avoid any of the ineligibility or unwarrantable status with them, I think it's going to be really, really important here. But I do want to specifically dive into what does this mean on the reserve study side with these new guidelines. So 3 major points here. Number 1, the elimination of the limited review. So now Fannie Mae and lending institutions are going to be requiring a full audit out there. From our knowledge, you know, it was a pretty easygoing audit. You could use some older documents to get by, older financial documents to get by. And that's no longer acceptable now. So the big thing right now, of course, working with your property managers out there and is ensuring that you do have updated good financials ready to go. If you do have potentially someone trying to get into the community, obtain a mortgage out there, they're going to have high expectations that you do have all your ducks in the row there and your financials are going to be ready to go to be submitted out there. The next big thing, which caused the biggest ripple in the industry too, was moving up the minimum requirement to your reserve account from 10% to 15%. So historically, Fannie Mae has always requested that communities do at least 10% of their annual assessments to go into the reserve account. They are now bumping it up to 15%. And that's actually not a huge impact, but it created a lot of confusion out there of what that meant. From this third bullet point too, reserve studies are really to be used to justify if your community is going to fund below the 15%. And with that being said too, you cannot use baseline funding. If you're going to go that route, if your community is not budgeting at least 15% to your annual to your budget next year, you must have a reserve study that backs up the why behind it. Why is it only 7? Why is it only 6%? That's where the reserve study comes into play to show. So that created a lot of confusion. When these guidelines first came out, a lot of people's perception, especially in the Chicagoland area where I'm at, was that everybody needed to follow the reserve study. And I can tell you folks right now, vast majority of associations that we work with, our recommendations are going to be significantly above 15%. Do we expect that every community that we work with is going to follow our studies to a 100% T? No. Realistically, that's not, it's not out there. Associations, there are certainly some associations out there that do set aside all of our recommendations, but it's pretty rare. So when these guidelines first came out, everybody's expectation was if we weren't following what the reserve study said, we were going to be placed in that do not fund list, which ended up being false. So we actually got in contact with Fannie Mae to clarify some of these guidelines. And I think most importantly now is on this 15%. So the expectation from Fannie Mae is that you still need to do a minimum of the 15%. If you have a reserve study done, and let's say it suggests that maybe you do 50% of your annual assessments out there, they're not going to reject you if you're not doing 50%. As long as you're hitting that minimum threshold of 15 of those annual assessments, you're still going to be clear out there. Once again, the only time the reserve study comes into play is if you're not doing 15%. If you're trying to pass a 5% budget to go to the reserves, then they need to show why. How is that possible? And that's where the reserve study will come into play. It's important to note, once again, you can't be using the baseline fundings, which is essentially the lowest recommended fundings out there. And the reserve study must also be 3 years or newer. So with that being said, Fannie Mae still highly recommends that all associations get reserve studies. Once again, even if the expectation is only doing 15%, which is truly on the low side of things, they truly do recommend that everybody is getting some sort of third-party guidance out there to define what their true needs are. And I think that's really important too, because these are just guidelines today. These can change. These are going to evolve, just like what we're seeing on the state side. We highly anticipate that things will change, and that having a third party and having a reserve study get involved is only going to become more important and more scrutinized too for communities.
Henry, just one quick clarifying thing in the moment just to address, because it did come from the chat, but this is really the only exception I want to make to this. Just a point of clarification so the attendees understand, because Mike in the chat asked, does the 15% relate to the spending budget or the revenue, like assessment budget? And I know you had it on your slide, but I just want to make it clear for the crowd.
Great question, and I'm glad to clarify this. This is on the revenue side. So 15% of annual assessments going in, it's going to be anticipated to go into a reserve account. So 50% of the revenue would be anticipated to be put into a reserve account. Great question, and thank you for the clarification. So next topic here, for those who are unfamiliar of what this reserve study is and how does it come to play, how do we come up with these results? Do just want to dive into what this is. So for those who are unfamiliar, reserve study really is just a game plan behind it. It's to focus in what our capital expenditures are going to be for our community. So it's really made up in two main parts. Number one being our physical analysis, where we're actually we're guiding what those expenditures are going to be. And number two, the financial analysis, where we are showcasing what the financials need to be for the community, building that funding path of where we should be, what those dues should be year in and year out to make sure that we have enough for these expenditures. So step number one on the physical side is we need to do some pre-work. We got to understand, what is your association responsible for? What are going to be those capital projects that we need to hone in on? We need to review your current financials. What's your budget at right now? And it's really important too that we review the maintenance history of the building too. When was your roof last replaced? Do you currently have a contractor that is doing preventive maintenance on your HVAC equipment? These are all really important things that we need to hone in on before we even conduct that inspection out there. So part of that responsibility matrix is finding out what your reserve components are going to be. Some very obvious ones out there for a lot of communities are going to be your roofs, your major equipment, your clubhouse, your parking lots, all the fun stuff that everybody sees every day and shares and uses are going to be some pretty obvious components out there. But oftentimes we work with a lot of associations that forget about some not so obvious components out there, like plumbing valves, building automation systems. subsurface utilities, especially for townhome communities out there. These are really important components too that not everybody sees. Our homeowners don't see these day in and day out, and we often forget about these. We forget about the upkeep of these and when they do need to be repaired or replaced. So the second step, once we determine what you are responsible for, we need to do a physical inspection of these. I think it's important to note that a reserve study is an independent opinion. What we're trying to do is gauge what is the remaining useful life and the cost to repair or replace these components. I highlighted independent opinion out there because the nice thing about a reserve study, we're not trying to sell you projects. A reserve study specialist isn't trying to force you into getting a new roof or force you into buying a new AC unit out there. We are simply trying to give you the most unbiased independent opinion of when is going to be a good timetable to expect a replacement for that. What is realistically, what can we anticipate those costs are going to be when we need to replace that component? It's really important that we're quantifying what these components are too. So when we're measuring our roofs, how many total squares do we have? Our parking lot, we got to look at the square footage for that. Our lobbies, these are all very important things that we need to quantify on the reserve studies to ultimately gauge what total costs are going to be and how we're going to appropriately phase these projects or get these done. We need to identify what the remaining useful lives are going to be. Now, I think this is a really important note to bring up too. I brought up earlier, once again, understanding the historical data behind it is very huge. You know, knowing when the last replacement was, knowing what the preventive maintenance history is really important for our team to gauge, you know, what's going to be the appropriate useful life on it. But I think it's a really big important note to highlight here is that reserve studies, they shouldn't be used to designate exact timing and exact cost. Unfortunately, we don't have a crystal ball. We can't tell you exactly what month and what year your roofs will exactly need to be replaced out there, or when your AC units or boilers are going to go out there. What our job is to give you a reasonable expectation of when that should be and how are we budgeting for that today. Yes, your roofs may last another 2 years of what we anticipated on the reserve study, but the idea of budgeting for them today, that's not going to go away. If we do get an additional year or two out of those, we still want to make sure we have a budget plan in place today that's collecting the funds to take on those projects, because it could go the opposite way too. We may have some water leaks reported earlier than that. We may need to do this project a little bit earlier. And if we are being proactive as a community and we are ahead of this, we should have the funds more easily available to take on these projects. It's important to note too, when we develop our costs as well, there's a lot that goes into it. We simply can't just go to a computer and type in roofing costs and get one specific number out there. It doesn't work that way. We got to make sure that these are very specific for your association. So your localized costs, the cost of doing a roof in Chicagoland is going to be vastly different to what it may be in Atlanta, Georgia. The type of materials that we're going to use are going to be significantly different out there. And all-inclusive costs too, demolition, disposal, getting permits, underlying conditions out there. These are all things we got to consider into that reserve study so that when we're building those numbers, we're trying to get to the truest recommendation out there that's going to fit the need. You know, ultimately, at the end of the day, when you as board members go out to bid, we want to make sure we're getting within the closest ballpark as possible.
Just to butt in too, on that last slide, I love that Henry included just the all-inclusive costs, because I know from my experience, speaking from my my manager days, one of the things that I would hear feedback-wise from boards sometimes would be like, hey, you know what, we got a quote in for, you know, roof replacement, since Henry brought that up as an example. And then like the bare price that they're seeing from like that roofing contractor isn't necessarily aligning with like what's on the reserve study. And one of the things that very much could be an effect of that is that, you know, that roofer is incorporating maybe only like their very specific costs, those materials, the labor, man hours, all of those things. They, you know, if they've got a good thorough proposal, hopefully that does have the demo and mobilization costs, but it might not have disposal. It might not have permitting. Most importantly, it might not have engineering. So I think when you, just as a point of reference and advice, when you are seeing some of those disparities, obviously there could be a variety of reasons, but we do see sometimes that like part of the factor is that some of those all-inclusive costs aren't necessarily what's being reflected on that, you know, that individual vendor's proposal. So just another kind of flag to keep an eye out for.
Yes, very good. I'm glad you brought that up, Eric. Yeah, it's certainly, once again, really important too that we're considering all these perspectives out there as well. And as we all know too, costs can change. Once we start peeling back the onion as well, there's always going to be some sort of surprises. So we want to make sure we're building in some sort of buffer as well for that. Going on with the engineering analysis too, when it comes to prioritizing these projects too, we always want to take structural and safety first versus the aesthetic projects. So of course, everybody wants the new renovated lobby. Everybody wants the fun stuff at the clubhouse, new renovations there. But if our roofs are falling off and our balconies are barely hanging on, we got to make sure we're taking care of those projects first, because that's going to be significantly more important. And then also too, another exercise that we got to consider too when we prioritize, what's the cost if we defer these projects? I keep on harping on roofs here, but it's such an easy example to pick. If we don't replace our roofs now and we start getting these water leaks reported, what is that additional cost going to be if we don't do anything? If we start getting more water infiltration out there, and those costs are going to spike up huge out there. So we want to consider that as well when we talk about prioritizing these projects on the reserve study. Another thought process here is combining these projects. If we're looking at siding and potentially balconies, is it going to be cheaper if we get these projects done at once too? Can we minimize shutdown time? Can we get a better quote from a contractor? These are all, once again, things we got to think about. And if we're considering maybe a potential big loan for the association too, to take on some major projects too, that's going to help gauge some of that prioritization as well. Once again, if we're going to be taking out a big loan, what are the main projects we should all take in once to maximize the use of that loan as well? So once again, like I said, doing the reserve study, some people think it's just putting numbers on a spreadsheet, but there's a lot of thought process that goes into here. And I think more importantly, every association is going to be very, very unique to their needs too. So making sure that we're collaborating with you guys to understand what those unique needs are is how we're really going to build the best reserve study. So at the end of all that, once we understand what you all are responsible for, how are we going to prioritize these projects? What are these realistic costs going to be? We can now dive into this financial analysis. And this is essentially the money map out here. This is your budgeting best friend. This is the recommended funding plan of what we believe those contributions should be year in and year out, mapped out to show when we go into each budgeting season, what are going to be those expenditure dollars we should expect, and what are those contributions? That green bar up there is really the money bar out there. And that's the end goal of the reserve study, ultimately, is to help you guys use this as a budgeting tool and understand for the next 30 years, what does this path look like as well? So with that being said, I kind of want to dive into our last section here of how do we use this report? We went through this process, we had a great inspection, we worked with the engineer, had really good collaboration on some of these projects and how we want to prioritize them, how we want to go about the scope of work. We got a really awesome funding plan here. It all makes sense. But now how do we put this to use? The last thing we want to do is put this reserve study, put it up on a shelf, let it collect dust, because there is a lot of value behind this too. So there's three main categories too when we think about using this report. Of course, we're going to be using it for our budgeting and our funding. Year in and year out, this should be your budgeting best friend, looking to see what are these assessments going to be. Do we need to consider a special assessment? Do we need to consider a bank loan? What are going to be these main expenditures coming up? Regulatory now. Once again, we hit this on the first part of this session here. Are we in a state where we need to get this reserve study done? Do we need to submit this to the state? Is there any kind of ordinances out there we need to be aware of? Are we fulfilling our association requirements as well? And then lastly, too, often overlooked too, when we're obtaining our bids for these projects, pull out that reserve study. There's a lot of good information in here to compare on these bids too, and making sure that we are getting the correct scope of work, understanding if there is any kind of alternative solutions out there, cost comparisons too. So I want to go over, what are these deliverables for the reserve study? What should you as a board manager or property manager really be keened in on and understand, what are you looking at when you have this report? And I think there's two main sections here. There's going to be the full PDF report and then also the spreadsheets. And I just kind of want to dive into how do we use these? First and foremost, I think is maybe the most often overlooked part of our report is the executive summary. And most providers also provide an executive summary. And cool thing about this is the entire report made up on 2 pages. All the information, all the recommendations are summarized here on the first 2 pages. Now, of course, there's obviously a lot of detail and a lot of analysis that goes into it, but this is a really easy summary to pull up and understand what's the cliff notes of this reserve study too. So when you want to reference something such as the priority projects or what the recommendations were for the dues increases, this is a really easy tool to just pull up and have all that condensed information on the first 2 pages. One of the most commonly used things too is going to be our expenditure tables. This is going to have all of our components listed with their timelines and costs too. So when we think about budgeting season, this is going to be top of mind out there to reference what those expenditures are, what those anticipated costs are going to be per year. And once again, looking into phasing and quantities too. Is this going to be a project that's going to be phased for 3 years? Are we going to be able to knock this out maybe in 1 or 2 years? So this expenditure table is going to be extremely, extremely important for budgeting season, easy to follow along as well, but really important. And then next is our narrative section as well. So this is the why behind everything. So of course we have our expenditure table that summarizes those costs, years, but now we can dive into where do these numbers come from and why? What was the provider recommending out there? What's the component history? What are the specialized notes that we had onto it? So I don't anticipate that every single board member, when you get a reserve study, we don't anticipate you guys to read every single page of the study. But I think it's really important too, when you dive into these year-specific projects, this is when it's good to pull up the narrative section and understand what those specific notes were. Was there any kind of alternative solutions out there that were presented by your provider too? But this is really just the why behind everything and very helpful to explain to our unit owners as well, a little bit more information on each project. And then of course too, budgeting season best friend, the funding plan. This is of course going to be our main resource right here to gauge what should we be contributing this year into that reserve account. Of course, with some of the new guidelines, a lot of we'll probably be implementing a percentage too, just to showcase if you're in the clear of the 15% or below it as well. But once again, this is just those recommended contributions. Are we at a good spot right here? What do we need to incorporate into the budget? What are those potential expenditures out there? And where should our account be? Once again, the reserve study, it's not going to be dollar for dollar on this, but we want to make sure we're in the ballpark of understanding where our reserve account should be at the beginning and end of each year. Oh. Now, another tool that's often overlooked that I highly, highly recommend as a board member is a 5-year breakout. There is a lot of information going on in these studies, but the 5-year outlook, I think, is the most impactful out here because here's the near-term projects. Of course, it's important for us not to forget about projects that are 10 years down the line that may have significant costs, but these are really what's out in front of you on your plate right now. So I always recommend to all board members I work with and all property managers, when you get the reserve study, please narrow in on the 5-year outlook because these really are those high priorities. With the 5-year outlook as well, there's going to be some sort of prioritization explaining what these projects are and how are they prioritized as well too. So when we think about budgeting season, again, take a look at the 5 years. Sometimes the 3rd year can be very overwhelming and it can be a lot of information to take in. But when we break it down to us what our near term is on those 5 years, it makes things a lot more digestible.
And just for reference to Henry, and for board members that were on our budget presentation a couple weeks ago, that's one of the very reasons that we started including in our budget templates that 5-year tab. Because if you do have a reserve study, whether it's a current one or one that's being worked on right now, we want to make sure that we're doing right by you all on the board and incorporating that reserve study information into your budget plan. So while obviously the priority is drafting, adopting, and getting into place your next year's operating budget for your fiscal year, we also want to include in that you're factoring in those upcoming 5 years of expenses out of your reserve so that they're constantly in the back of your mind and part of that long-term plan, not just for next year, but in perpetuity.
Absolutely. Yeah. No, it's a great point. Lastly here, a couple of tools too. The Excel spreadsheet. I'm the biggest fan of this of all time. I know every different providers out there have their own different tools. Our specific team, we really hype up the Excel spreadsheet because we do think it's really important. As a board member too, this is all your results built into one. So once again, when we talk about budgeting, we talk about upkeeping our information, it's really important that you have access to update all this. As you're completing projects, as you're getting real-time quotes and accepting bids out there, it's really important that you have the ability to go in and update those figures. Potentially, maybe you need to change some timing. Maybe there's a project that did get pushed off the next year. And this is just such an easy way to make sure that your community is up to date on that too. And I think more importantly that too, you can create your own scenarios on this too. So those what if scenarios. So you can mess with different things. You can adjust the inflation. If you think, unfortunately, if inflation you think is going to go up, you have the ability to go in there and kind of play with those different scenarios. You can add line items as well too, just to play with it and see, are we still going to be in a good spot? Does this still fall in line with our budget as well? So I think this is a often overlooked but really, really valuable tool. And I brought it up earlier as well too, but when we are contacting contractors and having them come out, take out that reserve study again. Look to see what that scope of work was. Make sure that your contractors are giving you the proper bid. What kind of materials are they quoting you? What's the quantities? Are they looking into any kind of phasing? These are all good things that you can reference on the reserve study too, and of course too the cost of it as well. Once again, we all anticipate everybody's going to come in at different pricings out there, but at least having the reserve study gives you some sort of guidelines out there of what to expect and what that proper scope should be. So I think it's really important too that boards are utilizing this when they have contractors submit their bids for various projects as well. One other piece of the reserve study too, once again, every provider may have their different spin on this, but a preventative maintenance plan. It's such a big deal when we think about capital expenditures out there, and ensuring that our communities are doing the proper preventative maintenance is really important too. So within your reserve study, it may look different with other providers, but there should be some sort of guidance on what you should do to make sure you're maximizing the life of your components. So make sure that you are utilizing that information, and that when you're doing your monthly, bi-yearly, whatever it may be, checklist, that you have some sort of reference that you are upkeeping up on your preventative maintenance as well. And I think most importantly, when it comes to budgeting season 2, contact your reserve study provider. There is a lot of information that goes in there, but you want to make sure that you work with good providers that are going to provide you with the support and assistance to help you understand and revisit any of those suggestions in the plan. Ultimately, we're all with you guys. We understand that being a board member is not easy out there. We want to make sure that the budgeting process is going to be as simple as possible for you. The last thing that we want to do is pass off the best baton and say best of luck to you guys. So I highly, highly encourage, whether you're working with us or a different provider, contact them. Make sure you do have the support. You understand what's going into that study, so that when questions do come up, you have the ability to walk through it and get some clarity behind that. And with that, I promise you guys 40 minutes. I was 38. Not too bad. I'm sure we probably got some questions.
We do. We have a lot of, I've been monitoring the chat as they've been coming in. There's a number to get to, all of which are really excellent. And I think a few were at some level answered during the presentation, but I think will be good to revisit. And then a few were totally fresh and great perspectives. So I think just going in order of submission, kind of going back to Susan's question. So Susan asks, will a townhouse or townhome HOA association be subject to the new reserve requirements next year? We are not a condominium association, we're an HOA.
Yeah, great question, Susan. I think it's really important too on these guidelines. One thing to bring up, we don't really know how this is all going to come to effect. And like I said, a lot of stuff's going to change out there. From my perspective, all associations should be following within these guidelines too, HOA or condos. I think the scrutiny is mostly going to be on shared buildings like condos, townhomes, where you do have shared roofs, shared structures out there where safety is involved. From my perspective, I encourage all associations, all communities, whether you're single family or not, to obtain reserve studies and to follow some funding guidance out there. If you don't have the reserve studies, still look for that 15% out there. That's just my perspective. Once again, I think if you ask different lawyers and Eric too, I'm happy to hear your perspective on that. I think you'll get a bunch of different answers, but the one common thing is all associations should have some sort of guidance when it comes to their funding.
Yeah, and there are things, and again, I think one of the things to reiterate too is that like we do have some variety here, right? Like there are states like Nevada, Florida, Delaware, others where there are already certain mandates in place on a state basis, on like the idea of just having to have a reserve study on a certain cadence. I know in Nevada, there's not only the requirement for the full reserve study every 5 years, but also the annual reviews. Whereas in Illinois, obviously, we're not in necessarily a mandate state, but these funding guidelines start to kind of get us closer and closer to that until legislation is passed that actually requires it at a certain cadence. Now, Susan, to directly your question, I will say there is a little bit, to Henry's point, there is a little bit of interpolation going on with the funding guidelines relative to single family home HOAs versus more shared resource community associations where you do have walls that are shared or abutting the next unit, or obviously vertical condominium associations. I do know that we've got some upcoming education coming from like attorney opinions on some of those things, which will be helpful. But we can, I think, Susan, the best thing that I would recommend more specific to your association is getting in touch with your manager and making sure you guys get a little bit of legal perspective as well, just to make sure, because there can be particulars that, are affected by your governing documents, that are affected by the state, and things of that nature. But there is a little bit of variance depending on who you talk to between single family home HOAs and condo associations. But I think there's still some of that that's being left open to interpretation right now. Michael asks, just to confirm, is 15% required in Illinois or just a guide? I'm happy. I'll just chime in with a little bit of my perspective on that one. So the thing to keep in mind here is like, and I kind of alluded to it. So in Illinois specifically for you, Michael, there isn't legislation as of today's date that says every, like I just mentioned in Nevada or Florida or other states that have actual mandates that say every X amount of years you have to have a full reserve study, and then every X amount of years you have to have, limited review studies and things of that nature. So by definition, there technically isn't a, quote unquote requirement saying that you have to have that reserve study in Illinois, or that you necessarily are legally following that funding plan. The problem, though, is that because these are Fannie and Freddie guidelines that really dictate like conventional financing, if you're not hitting those requirements that are set forth by Fannie and Freddie guidelines, it is going to be near impossible to have like transactions, sales and purchases into your community that are not meeting those conventional funding guidelines. That would essentially mean that like you're limited. You could end up on that do not lend list that Henry made reference to previously, or you could be limited to having only cash offers being the only real means of people being able to sell or purchase in your community. So while it might not be, a quote unquote legal mandate, it does create a number of operational issues for the association, at least in Illinois, so that, you don't want to be in the position of owners coming back to the board saying, hey, none of us can sell our units, through conventional financing, potential great purchasers into your community not being able to buy into the community because conventional financing can't be captured. And so those consequences are really what makes this, it's not a mandate, but it's going to create a lot of struggles and hurdles for your community if you're not making that big effort to follow those lending guidelines as closely as possible. Henry, what do you have?
No, you hit it right on the head. It's once again, there's two buckets out there. There's that state legislation side, specifically for us in Illinois, nothing right now. Right now, our condo law states you need reasonable reserves, which is extremely, extremely subjective too. But Eric hit it right on the head too. This is just the way things are changing out there. The 15%, this is coming from Fannie Mae, Freddie Mac guidelines that everybody should be doing that minimum 15%. And I think it's important to note that's just the minimum. The end goal here too, the best recommendation is getting a third party to guide you what your unique needs may be. Once again, most of the associations we work with, it's going to be way above 15%. 15% is pretty low for a lot of associations too. And when we think holistically about this too, this is just board members fulfilling their fiduciary responsibility. This is to avoid deferred maintenance. It's to avoid these situations that unfortunately a lot of associations get into, where we do need to pass special assessments, and it may be unfair for new community members in there. So yeah, Eric, you hit it right on the head, but I think it's my biggest takeaway is, once again, industry is changing a lot. I think best recommendation right now is to get a reserve study and follow those recommendations to your best ability.
Thanks, Henry. We did have a comment from Mark on the call too, that he's actually working with reserve advisors right now via the management team. And it looks like they are looking to see when their reserve study is going to be ready. So I think, Henry, without me volunteering you, is the suggestion for Mark to reach out to you maybe to get status on his community's reserve study?
Certainly, yeah, Mark, you can absolutely reach out to me, the lead engineer that was working on the on-site inspection too. Please, I highly encourage you. It looks like if it was a typically turnaround time for us is 3 to 4 weeks. So that's pending to make sure we have all the information needed out there. But please reach out to me, and we will certainly get back to you and understand where you're at in the process to make sure you guys get your study.
Excellent.
I think.
Tanya makes a comment that I just wanted to touch on too, less a question, but I think a good one to just point out again in relation to like different state statutes. So Tanya mentions that the ombudsman checks in Nevada, they check the HOAs for reserve studies and funding. So that's a great point. So like when Henry had a slide talking about like who's policing this, for states like Illinois, obviously, where, you know, some of these guidelines and some of these restrictions that are starting to come into play are a little bit fresher and they're in process right now. Like they do not have that infrastructure, the state staffing model, all of those processes and procedures in place. Nevada, on the other hand, has had these mandates for quite some time. So they do have a much more regimented, formalized process via the state, via NRS guidelines and things of that nature. So some of your states, whether you're Nevada, Florida, Delaware, a number of others that have a lot stricter guidelines. I know Oregon has some restrictions around that. Virginia as well, I believe, is every 5 years. California is every 3 years with annual reviews in place. So there are more specific guidelines that do govern some of these things in your states. But yes, in some cases where this has been in place for some time, there is a lot more formality, structure, real policing that does go in beyond just what lenders and Fannie and Freddie are working on.
Certainly. Yep. Same thing. If there's anybody from Florida too, if you qualify for the CSRS, that does have to get submitted to the state on their online portal too. So every state's going to be very unique. And then once again, what Eric alluded to, you know, the policing behind it in most states, there's not those requirements right now too. So when the question gets asked of, do we really need to do this reserve study? This is where the lending institutions are really the people that are checking in on this to make sure, are you qualified for this? So every state's going to be a little bit different, and as that could change for most people too.
Thank you. A kind of a two-pronged question here from Stan on the call, but Stan mentions, so 15% recommended for baseline funding only. And then with that, so for threshold funding, our association could fund reserves with percentage of revenue less than 15%. So I think the first part of that is, you know, is the 15% recommended for baseline funding only?
Yeah. So once again, baseline funding is a no-go for the Fannie Mae guidelines. What baseline funding essentially is a way to do a reserve study plan where your reserve account is going to actually hit a zero. It's the bare minimums going into a account. Now, this is where the guidelines get a little subjective too. So a threshold funding, essentially what that means is it's not full funding out there. It's building a cushion beyond the baseline. So it's building a path to make sure you are budgeting properly for your expenditures, and also building a little bit of a cushion in there too, beyond just planning for your reserve account to hit zero. So within these guidelines, now it gets a little funny too, because technically 1% above that, let's just say if our expenditures, if we just build in a 1% cushion where you just have a little bit extra in that reserve account, that's theoretically a threshold funding, and that's theoretically acceptable out there too. So once again, the whole idea behind it, if you're going to be going less than 15%, you need to just show a path on that reserve study that shows some sort of threshold funding out there. Very unique. Once again, this is where these guidelines have a lot of subjectivity to them, and where things will probably change again in the future. It just has to be some sort of cushion where your reserve account is not anticipated to hit zero. Does that make sense? And I would say in most, our practice, especially ourselves, the way we approach reserve studies, we always do the threshold method out there. We always want to build a cushion because there's going to be a lot of things are going to change out there too. Once again, we can never be 100% right on each exact number out there too. So we need to build that cushion, and it depends on the association. Some associations, we build in higher cushions for very luxury high-rise condominiums. We need to have a big cushion because those project expenses can vary a ton, so we want to make sure we build it in. For more simpler properties, we don't need a huge 50% cushion out there because there's a lot less risk involved out there as well. So in practice, your reserve study provider, when they use the threshold, it's going to be a suitable path. It's going to be a viable path, and that's what Fannie Mae and Freddie Mac are looking for.
Excellent. Thanks, Henry. Another one that I think I can probably take, and then if you have any further input, let me know, Henry. But Barbara asks, so if the 15% is from the revenue, does that include only unit and parking assessments? Our special assessment is listed as revenue, but this is allocated toward a loan we are paying off, so not technically quote unquote revenue. So my perspective here is that special assessments, particularly one to repay a loan that was utilized for capital or reserves expenses, that would be professionally considered as non-operating income. So like that being said, like your special assessment, if that is income that's being collected to repay like a long-term liability, like a loan, or you guys are, we've had an association in the past where based on their reserve study, they knew that they had a subsection of their community because there were like limited common elements involved. They did have a special assessment that was passed to fund towards an eventual porch replacement, I believe it was. And so they started collecting a reserve contribution or a special assessment, a very long-term one at a low monthly dollar rate, but that was going for a very long time to go towards that capital replacement. Now, that income was not for the operating budget. That was not to pay day-to-day expenses. That was not to pay this year's annualized or recurring maintenance or reactive repairs. That was separately allocated and earmarked for eventual reserves expense. So a short answer is that your special assessment income, unless that was passed with the purpose of, emergency, like on an emergency basis, funding your operating account because you have a severe cash flow problem, I would say that that special assessment income is not considered part of that 15% because that would be right. Like if you had, let's say $500,000 being collected in your special assessment, but you're a community that only collects $200,000 annually in your regular assessments, it doesn't quite make sense that, Fannie and Freddie are going to expect that you're contributing 15% of, $900,000 or whatever that number ends up being. So for all intents and purposes, that revenue number that's being referenced, that is based on your regular expected operating income and expenses, rather than, factoring in long-term special assessment income or other things of that nature. Henry, is there anything that in your experience differs from that, or are you aligned with that?
No, I'm aligned with you on that too. Yeah, no self-promotion here too, if you don't mind, Eric. We actually do have a Fannie Mae webinar coming up with a representative from Fannie Mae on Thursday. So this is the opportunity. It's going to be a live webinar to ask a lot of these good questions directly from Fannie Mae too. And this is the reason why we wanted to bring it in, just so people can get straight from the source of some of these really good questions. So once again, I hate to self-promote, but on our website too, if you're interested in that, I think these are really great questions that we'd like to present to Fannie Mae directly too. We do have a webinar link for that on our website as well. But yeah, I'm in alignment with you, Eric.
Thank you. And yeah, I will say, like my perspective and position on that is also informed by conversations we have had with folks in legal and things like that. So that is an informed opinion. I will say I would also recommend, I think the webinar that Henry mentions is also a good opportunity if you do have the availability. We'll also make sure that we share some notes from that as well, because we do have some individuals planning on attending. But that would be a great one just to get some additional, confirmation for everyone's sake. But hopefully that helps, Barbara.
Eric, can I jump in here? I saw a question that even my board will ask too. They say, why do reserve studies cost so much? I'm with a small development in Chicago, 18 units. I looked at getting a reserve study, even though it's not required yet here in Illinois. They wanted $4,000. Now, to my people, that sounds like a lot. And maybe Henry can answer this. I mean, I'm not entirely surprised, but I don't know everything. By the way, Henry, this is an excellent presentation. Very good presentation.
Thank you. Thank you. No, I think it's a really great question too. And of course, the perspective on the reserve study costs are going to be different. Some people might think that $4,000 is a steal out there for their association, but I think it's important to note, what gets brought into this. And the second section of this presentation that I brought into, kind of how we make that, what goes into the special sauce, it involves a lot of time and a lot of labor out there. It's not just simply us going online and looking up costs for things. We can't just simply go to these data reference books and pull out numbers, because every association is extremely unique. We talked about some of those costs and how those variables get put into play, collaborating with you as board members, your management team, to understand some of that preventive maintenance history to really make sure that you get a good defined reserve study. And today's world too, we have to be giving out good, accurate reserve studies. We can't just wing these things too with all the scrutiny out there. So it takes a lot of time, it takes a lot of effort. And once again, there's no same association. Everybody's completely unique. So there is a lot of efforts that go into that to ensure that your association has the proper reserve study and that you guys can rely on that and make good informed decisions for your budgeting. Hopefully that makes sense, but certainly there's a lot that goes into it. And I think those are reasonable costs for reserve studies.
Thanks, Henry. I mean, I wasn't surprised, but my board likes to be very economical. I'll put it politely. I'm sure Eric has dealt with this here in Chicago with some board.
And certainly one thing to consider too, what's the cost of not knowing these? What is the risk cost of not having a third party opinion out there when something does fail? What's that extra cost when we could have done something years ago and prevented that issue too? Once again, as I brought up earlier, reserve study is not to sell you guys these projects. It's really just to give you the best information possible to know what to expect in the future and how to go about those. And I can tell you from our experience, the associations that wait a long time before they do these reserve studies, after their first one, they always say the same thing. They always say, we should have got this done years ago. We would have been in a much better spot had we just done this practice many years ago and helped set ourselves up.
Thanks, Henry. We have a few more questions that were in the chat that I think are worth getting to for sure. One of them is from MJ asks, what if your association has preferred to run lean, keeping assessments low and using special assessments on a reactive basis? Our most recent study suggested that based on maintenance needs of our building, that we should be collecting $275 per month per owner more to fund them. How should we be thinking about that?
Yeah, once again, it's where the collaboration effort comes in. It's that delicate balance of understanding what's going to be a reasonable plan for you guys, but also at the same time, our engineering credentials are on the line too. We have to make sure that we are giving sound advice and that we are ensuring that these capital projects are being funded the right way too. So I don't know if this is a perfect answer for you, MJ, but in a lot of situations, this is where the collaboration comes in. We have to understand, we have to build a reasonable plan that's going to ensure that you guys are going to be set up for success to take on these projects. But at the same time, we can't just go in there and say you guys are doing it all wrong and special assessments shouldn't be considered and bank loans shouldn't be considered, jack up your dues. We know that's not reasonable. So that's where the collaboration does come in.
Yeah, and I think this is an interesting one to give a little bit of management perspective too, and because I definitely, speaking from my experience, for those that don't know, I live in a 4-unit condominium association myself, so very small association in Chicago. One of the things that I found interesting was that our building, when we moved in and bought 5 years ago, very much has always run the same way, where we're a small building, we have 0 amenities, we have, our assessments were fairly low when we moved in, and generally the culture in the building has always been very similar to yours, MJ, that when we do have, issues that come up, roof related, big CapEx, whatever the case is, everyone has just said, let's just special assess it. Now, I personally and my family, We have the, fortunately in the 5 years, we've had the means to do that. And we've been comfortable with, the way that they've operated. What I will say, that is short-sighted. And I've shared this with my other board members in that we are the owners and the board right now. My wife and I are going to be probably selling our place in the next 6 months and moving into a home. A lot of our neighbors might be doing the same. My personal professional opinion is that you need to be making, you have fiduciary duty to exercise here. And I think that's the biggest thing. You need to be making decisions for your community as its business, as a corporation, not based on how, the comfort level of your fellow owners within the community and among the board. I do not doubt that the way you guys have approached it has totally worked for your association as it's worked for mine. But there's legacy that you need to think about. You need to think about the longevity of the community, the future owners, the future boards. If they come back to you as a board and say, you know what, the way that you guys did all these things, or just didn't plan to have, that nest egg or that contingency fund or whatever the case is, that could come back to bite you, or that could just, leave others, what if you get a whole new regime that comes in and has a completely different perspective? So what I would say is that while that might be totally functional and it's worked for your community, I will say exploring, following these funding guidelines does, it's the reason that they're built out for decades down the line. You're thinking about the longevity of the community beyond just your current, status within it, if that makes sense.
Mm-hmm. Yeah, well said, Eric, too. Yeah, I mean, that's the thought process in reserve study too. You're paying for the use today to set yourself up for the future. You're paying your fair share out there, and just relying on special assessments. It may have worked out historically perfectly for you guys too, but it's not typically the most practical approach to go. And just the way the costs are rising on everything too, it's certainly a shock for everybody to see some of these new project costs come in too. So it's just understanding you have the clarity behind what those potential costs may be, and just having a plan. And by all means, if you guys still want a special assess for those, it's your guys' discretion on that. But I think just having information available and making sure you guys can make informed decisions for what's going to be right for the community is most important.
Thank you. If folks are okay with staying over just a few minutes, we do have a few other questions that are good. If folks do have to depart, again, we will be sharing the recording with folks. So don't think, if you do have something to get to, dinner, whatever the case might be, feel free. I don't want to bogart your time, but just a couple more questions. Henry, if you don't mind, if we run through a couple.
Certainly.
But a couple more that I want to touch on. Nashua asks, could you please clarify the typical shelf life of a reserve study? Additionally, if our association faces unexpected large expenses, such as drainage repairs, or discovers that reserve funds have been improperly allocated, should we trigger an update to our reserve study immediately rather than, waiting for the next natural time to do so?
Yeah, great question out there. So industry standard, typically for reserve studies, the most common practice is 3 to 5 years. You want to get those updated. What Fannie Mae is actually suggesting in their guidelines too, they're saying every 3 years, 36 months. So pretty aggressive to make sure that those are being updated. As I alluded to earlier too, there's a lot of changes out there, and there's good reasons why reserve studies need to be updated. A lot of things are out of all of our control. We can't control inflation out there. We can have a good idea of and sense of what inflation could be on the short term, but there's just so many things out there. We can't control wars. We can't control COVID and natural disasters out there. So yes, it is very important too that we keep these updated. 3 to 5 years is still the industry standard out there. And really, our perspective on it, it really depends on your association. If you are going through a lot of expenditures, a lot of changes out there, get it updated, get information in front of you. The more recent, the better. Now, if you're in a community too, where you don't have a lot of expenditures, you guys have been doing a pretty good job. There's not a lot of projects going on. You don't necessarily need to get that updated right away every single year. You may be in a good spot. So it's really association based, but within a 3 to 5 year time frame, is really going to be a good analysis out there. And once again, too, it depends on your state. You could be in a state where it requires annual updates, like California, I believe Nevada too, if I'm not mistaken. And most states, the trend, like I said earlier too, is leaning towards this every 5 years. So there certainly is a shelf life on it. And in best practice, you should be getting those updated.
Aaron also asks if the HOA is funding reserves at a level less than recommended by the study, or has a great deal of catch up to fund at a stable or good level, is there risk that it could impact property owners selling their units?
Yeah. So let me read that one again. Is the issue? Great deal of catch. I mean, certainly. Once again, the idea of auditing and looking at our financials and having the reserve study be involved with these mortgages and with the closing is just becoming more and more important out there. So people are becoming smarter. Buyers are becoming a lot smarter, and lenders are requiring for this a lot more. So the idea of understanding what is the risk that's going into getting involved with the property is certainly going to have an impact on it. Like I said, too, the study I found earlier, too, the communities that were on the current blacklist are experiencing a 5 to 30% decrease in home values just because they're on that current blacklist out there. So there's certainly a risk of funding reserves less than the recommended level out there. But it's case by case once again. You know, do all of the associations we work fund exactly what it says? No, most people don't, but you got to make sure you're in a reasonable spot where you're not underfunding, tremendously underfunding, and I think more importantly, deferring maintenance too, pushing off projects. That's the biggest no-go out there, because once again, those projects are only going to get more expensive, and you're only going to have a hard time building up those funds again in the future. Hopefully I answered that question pretty good. Eric, do you have any other thoughts in there?
Yeah, I mean, I think that this gets to just this general sense of like, part of this is the annualized reserve funding requirements that Fannie and Freddie are pushing are like their one thing. There's a little bit of a separate kind of like assessment that you have to do, like whether that's lenders looking at it, whether it's the attorneys involved with sales transactions, they'll look at your reserves balances. Whether or not they're concerned about what the overall like past funding plan has been or current reserves level are at, that can be a little bit more eye in the beholder. We've had sales go through at community associations with next to nothing in reserves, but there's the context in that, you know, in that disclosure that the reason the reserves are low is because the association actually just recently accomplished a number of projects. So it's all about the context. There might be, you know, your reserve might be in what you think is like a pretty dire spot. But if that is in the context of having done a lot of projects and keeping up with your maintenance plan and taking on those things, that very much matters in the sale. And that might not raise a flag to that lender. If they see that you have little to nothing in reserves and have a history of not contributing to that reserves, and you have a bunch of deferred maintenance, that will absolutely impact the ability for that sale to go through. So there's some of this that, you know, the 15% requirement is it's one thing, but it's a little bit more eye in the beholder when, you know, underwriters and lenders are looking at the status of these things, whether or not the community is kept up with that maintenance plan, whether or not the reserves in context of past or future projects is healthy or not. So there's a lot of those variables where that can definitely play a factor. I'm trying to see if there a few questions were kind of repeats or just rephrased of prior questions. One that I don't know that I think this will actually be in the interest of kind of sharing like the right expert. There is a question from Barbara about, will there be a grace period when, if this goes into law in our state, to get a reserve study complete? Assume you can't get this done in a few weeks with scheduling. And then she, along with that, how long does it take to get a reserve study? Which I think you kind of alluded to already, Henry, per Mark's question. But like the grace period question, Barbara, in complete honesty, I think it's probably best to get a little bit of legal advice. I will say we do have a webinar coming up, at least for our Illinois customers. I know we have others being scheduled with our Nevada customers, our Georgia, our Missouri customers, and Florida as well. But we will be doing a series of localized legal updates around this so that you can ask specific to your state, what, if any, grace period there will be. I know that like the January 4th, 2027 date has been shown for the Fannie and Freddie guidelines. You know, I imagine there might be certain, you know, whether it's exceptions or other things made for, hey, we have, you know, we contracted with a reserve study provider. They're working on it right now. I would imagine there might be a little bit of grace given for situations like that. I just don't want to say that and then suddenly that isn't the case. So I would definitely lean on legal there. But I will say we've got invites going out for at least the Illinois one, and we have some other series going in September and October for other states that we operate in as well.
Yeah, very well said, Eric. You know, from my perspective, very similar. Typically, there is going to be some sort of grace period built in. And I think what a lot of states are doing right now, too, is kind of using Florida as this guinea pig of what's the right way to shape these laws. You know, here in Illinois, I know we bring up Illinois a lot, too. Once again, everybody's on board to having some sort of mandate for reserve studies. It's just a matter of how do we tweak this and make this the right bill and make this make sense for everybody. So I think that's what a lot of states are going through right now too, just trying to make sure that it's reasonable for everybody. We're including the right communities and having the right requirements in there. But what I would say from our perspective too, when we see states pass these, there usually is a little bit of a grace period. They understand that providers are going to obviously get busy in those states too, and that they're not going to be able to get to everybody all at once too. And then, yeah, typically for reserve studies, backlog, typically 8 to 12 weeks from signing services to getting them completed. Of course, work with your provider. It could be a lot different. There's different circumstances. We try expediting things when we need to for budgets and whatnot out there. But yeah, hopefully that answers your question.
Excellent. I think that largely covers most of the questions. There's one very quick one that I'll take just to put Julie at ease. Julie asked, we have one of 7 reserve bank accounts as a money market sitting in the same bank as our operating account, putting us way over the $250,000 FDIC insurable limit. So I do know, so with Alliance, so our 2 banking partners here at Westward 360 are Alliance Bank and Wintrust. Wintrust also goes by Barrington Bank and Community Advantage. So if that's your bank, that it's all Wintrust as well. I will say the way that they diversify their money market accounts, even though you might have a statement that lists a total reserves balance beyond that $250,000 limit, they do compartmentalize those all on the reserves accounts to ensure that no more than $250,000 is actually kept in any one of those individual money markets, CDs, anything of that nature. So whether you're with Alliance, whether you're with Wintrust, or even like your third-party provider, if you're a community that's working with another bank for some of your reserves funding, they should be diversifying that. But for sure, with Alliance and with Wintrust, if that's where you have all of those accounts, they are ensuring that no more than that $250,000 limit is in each of those. So there shouldn't be a single dollar that is uninsured or uninsurable for your 7 accounts that you currently hold with your community. One good point too that I do want to, Susan actually makes the comment, which I think you'll appreciate, Henry. Susan mentions, this is good for you, Jan, but remind the gentleman from the 18-unit condo, the updates to the reserve study generally are much less expensive than the original one. So do know that like when those updates, and Henry can probably opine on this more, but that is a good thing to keep in mind.
Susan, I just read that comment and thank you. Yes, you bring up a really good point. Once again, our very first time working with the community takes a lot more effort. We got to understand these things. We got to build it. We got to go through that responsibility matrix and understand, who's responsible for what, quantify all of those. Certainly updates are really important, but when we update, we have the bones in place. That saves a lot of labor time. So those costs do go down typically for updates out there. So yes, thank you so much, Susan. That is a really great reminder.
Excellent. And then finally, just Eric, you asked, we have a reserve study. We're 88-unit high-rise, not happy with what we have. Should we consider a fresh reset or trying to build from the study we have? Henry?
Yeah, I mean, great point, Eric. I mean, first and foremost, I'm not sure if it was us or a different provider out there. Consult with your provider, though. Explain why you're not happy. This is where you need that support to understand where's the disconnect. Is it on cost? Is it on recommendations, priorities out there? We got to understand, where the disconnect's going first and how to resolve that. And should you consider a fresh reset? I'm not sure if this is an older study. More than likely, yes, you probably would want to take a very fresh perspective on that. There's a lot of variables that go in play. And Eric, I'd be more than happy to talk to you offline too. But I think number one is figuring out the root cause of what's not making it happy, what's missing there, and then going from there to understand what's going to be the best next steps, whether that's a new study or making tweaks to what you got right now.
Excellent.
Thanks so much. And by the way, thanks for the whole presentation. It was very helpful.
Thank you, Eric.
Excellent. Glad to hear it. Well, with that, I know we've kept you guys a little bit longer than anticipated, but I thought that just a lot of the questions just showed a lot of it was great input. I think that these are all really helpful, and I'm glad that folks did ask them. Thank you. first, just to everyone who attended, we really appreciate you continuing to participate in these. These are fun and exciting. We like doing these. We like making sure that you feel comfortable, better educated on these topics. If you have suggestions on future ones that we can cover, please do send those our way. Big, huge thank you to Henry. I think reserve studies are one of the things that we get asked about most frequently, and they're probably one of the most complicated and detailed kind of reports that exist in our industry. Getting through 40 minutes and allowing a lot of good Q&A is just great. I think I'm just impressed. So thank you, Henry, for boiling it down into easily digestible bits and snippets here and giving us a lot of great guidance.
No, thank you guys. Once again, this has been a pleasure. The input interaction here has been phenomenal. And I certainly want to make sure we do get any question that was unanswered, eventually answered. So Eric, please follow up with me if there's anything that we could follow up with everybody on. But thank you guys. Thank you for your time today. I appreciate all the partnership with Westward Communities. Even if you're not with Westward, we certainly appreciate you joining us today. This has been a phenomenal session, and things are, once again, they're changing a lot out here, and we're here to help educate and be in the boat with you guys and understand what we can do to make sure our communities are in the best spot possible.
Excellent. And we'll continue to keep folks updated as any of these progress things just develop with the reserve study industry or anything in any of the states that we operate in. We'll make sure that you remain informed. Do look out. We will be sending out links to copies of the recording of the session along with notes. So do look out for that in the coming days. I'd expect that likely by Friday, if not by Monday at the latest, we'll have that session. In the meantime, we'll be able to get you materials from the webinar just so that you've got something to kind of peruse and share with your fellow board members. Thank you, everyone, and have a great evening. We really appreciate it, and hope to see you next time.